You ever notice how people will argue for 15 minutes to save $5 on a delivery fee, but will happily lock themselves into a $450 to $600 monthly car payment for the next 5 years without thinking twice? Like, someone will refuse to tip $2 extra at Starbucks, then walk into a dealership and sign a contract committing more money each month than they spend on groceries. And the wild part? Most people think they bought a car. What they actually bought was a 5-year lifestyle contract disguised as a vehicle. My name is Nico, and I spend way too much time thinking about why people feel broke, even though they're earning more than ever. If you're someone who has ever looked at your bank account and said, "Where the hell is all my money going?" make sure to hit that subscribe button. Give this video a thumbs up if it helps you out, because today, we're talking about the quiet financial trap that has destroyed more wealth for Americans than almost anything else: car payments. Most people don't buy cars, they buy monthly payment identities. When you tell a dealership, "My budget is around $400 to $500 a month," they don't hear, "I want something affordable." They hear, "Trap me into the maximum lifestyle possible." Here's a stat nobody talks about. According to a 2023 Experian Auto Finance report, 85% of buyers only know their monthly payment, not the total loan cost. 85%. Dealerships love this because if they control the monthly payment, they can hide everything else. Interest fees, taxes, add-ons, extended warranties, inflated insurance, all buried inside one easy payment. You thought you bought a $27,000 car, but the real math? It becomes a $50,000 to $60,000 lifestyle commitment. Let me show you the breakdown. Why smart people fall for this. This isn't about stupidity, it's about psychology, and car companies are experts at manipulating it. Trap number 1, the "I deserve it" fallacy. You have a stressful month, you get a small raise, you feel tired, and suddenly, you know what? I deserve a nice car. Cars are socially acceptable financial mistakes. Buy a $2,000 couch and people judge you. Buy a $40,000 car and people clap. Not because it's smart, because it symbolizes success. Trap number 2, monthly payment mirage. If I tell you this car costs $32,000, your brain says, "That's a lot." But if I say it's only $469 a month, your brain says, "I can handle that." Same car, different psychological doorway. Trap number 3, loss aversion. Only a few units left. Prices will increase next month. This interest rate is available only today. This triggers fear of missing out. You don't buy because it's a deal. You buy to avoid losing the chance. Trap number 4, lifestyle anchoring. You sit in the premium model. It smells nice. It's comfortable. Suddenly, the cheaper one feels too basic. You walked in wanting a $20,000 car. You walked out with a $35,000 one. Not because you needed it, but because your brain got anchored to better. The math they hope you never do. Let's break down a realistic U.S. car loan. Suppose you buy car price $30,000, down payment $3,000, loan amount $27,000, interest rate 8% loan term, 72 months, because most Americans do this now. Your monthly payment, approximately $475 per month. Now let's calculate the real 6-year cost. 1. Monthly payments, $475 times 72 equals $34,200. 2. Gas, $150 per month average. $150 times 72 equals $10,800. 3. Insurance, $1,800 per year. 6 years equals $10,800. 4. Maintenance and repairs, approximately $3,000 to $5,000. 5. Depreciation. Your $30,000 car is worth maybe $12,000 after 6 years. Depreciation loss equals $18,000. Total 6-year cost, $34,200. $10,800. $10,800. $4,000. $18,000 equals $77,800. You thought you bought a $30,000 car? You actually bought a $78,000 financial lifestyle. The debt snowball nobody sees. The car payment is not the problem. The obligation is the problem. When you commit to $500 a month for 6 years, you immediately lose job flexibility, career freedom, risk-taking ability, savings potential, emotional breathing room. Your car payment becomes your new minimum survival income. Debt isn't just math. Debt is behavior control. Most Americans don't even finish paying off the car. Guess what they do instead? Upgrade. It's only $40 more per month. Might as well get something newer. I've had this one for 5 years, and boom, the cycle resets. You stay in car debt for 20 to 30. You don't notice what you're giving up. Let me make it visible. Sacrifice number 1, lost investing power. If you invested $475 per month instead of paying for a car at 10% return, 6 years, $39,000, 10 years, $92,000, 20 years, $305,000. So your affordable car? It costs you a potential $300,000 in future wealth. Not a joke, not a theory. That's compound interest math. Sacrifice number 2, career flexibility. Most people stay in miserable jobs because they can't afford to quit. Why? Because the car payment won't let them. Your car is making your career choices for you. Sacrifice number 3, emergency risk. Most Americans with car payments have less than $1,000 saved. One job loss, one emergency, one unexpected bill equals complete financial disaster. Sacrifice number 4, relationship stress. Money fights come from a lack of buffer. A $500 car payment removes your financial buffer. A single unexpected bill becomes an argument. Addressing objections. Let's handle the objections I already know are coming. Objection 1. But Nico, I need a car. Yes, you need transportation, not a luxury lifestyle. There's a difference between needing a car and needing a brand new $35,000 SUV with leather seats and a giant touchscreen. Objection 2. Everyone has a car payment. Everyone is stressed and broke too. Normal doesn't mean smart. Objection 3. I can afford the monthly payment. Affording the monthly payment is not the same as affording the car. True affordability means this does not affect my future wealth. Most people can afford $500 per month. Very few can afford losing $300,000 in future wealth. Objection 4. But it makes my life easier. Short-term ease. Long-term damage? Exactly like junk food. The better strategy. Okay, enough frustration. Let's fix this. Step 1. Follow the 20-40-10 rule. This rule is used globally by smart financial planners. 20% down 4-year loan. Max 10% of take-home income cap. Meaning, if you earn $4,000 a month, your car payment must be less than or equal to $400. If you earn $6,000 per month, less than or equal to $600. This rule automatically prevents stupid decisions. Step 2. Buy 2 to 3 years used instead of new. A new car loses 20% the moment you drive off the lot. A 2 to 3-year-old car has already taken the biggest depreciation hit, is 25 to 35% cheaper, still looks new, has low mileage, lasts just as long. Financially smart people do this. Middle-class people buy new. Rich people buy assets. Step 3. Drive your car longer. The real wealth hack. Pay off your car, keep it 4 more years, invest the old payment. This one move can make you $100,000 to $150,000 richer. Step 4. If you can't buy used, buy cheaper. Nobody will remember what car you drove in 10 years, but you will remember whether you became financially free or financially stuck. Step 5. Never let a car define your identity. Your identity should come from your goals, your skills, your mindset, not from a metal box with wheels that loses value every month. The mindset shift. Here's where it gets really interesting. People don't buy cars because they need them. People buy cars because of psychology. They want to feel successful. They want approval. They want comfort. They want to feel grown up. They want social validation. But here's the truth. The richest people you know drive cars that don't look rich. Why? Because their money is working for them, not sitting in their driveway. If you've watched this far, here's your reality check. You do not have to be financially enslaved by a car payment. You can. Buy smarter, buy cheaper. Buy used, buy with rules, buy without ego. And when you do, you unlock savings, investment power, career freedom, mental peace, long-term wealth. I'm not here to judge your car. I'm here to help you build a future where money works for you, not the other way around. If this video helped you see car payments differently, smash that like button, subscribe, and share this with someone who needs to hear it, because trust me,